All right, welcome to the deep dive. This is where we grab a whole stack of info. Could be articles, research, our own notes, you name it.
And we basically pull out the key bits, the real nuggets of insight.
Exactly. Give you a shortcut to, well, really knowing what's going on. Today, our mission is digging into the wisdom of a real legend, often kind of seen as the quiet genius behind another big name.
Charles T. Munger.
Munger, yeah. And specifically, we're looking at his 1998 shareholder letter for Wesco Financial Corporation.
And it's a great pick for a deep dive. Munger's letters for Wesco, they weren't frequent, not like some others.
Right, not a quarterly dump of data.
No, exactly. But when he did write one, wow, the insights were just so concentrated, really profound stuff, sometimes with that, classic Munger wit.
A masterclass in, compact wisdom.
Definitely.
And this 98 letter is a prime example. So we've got the letter itself. We've sort of prepped some analytical questions to really get inside his head, understand his view on investing, business, life even.
And the timing is key, isn't it? 1998.
Yeah, the economic backdrop. Munger himself called it, what was it? Frothy markets for securities.
And super ebullient markets for entire businesses.
Yeah.
You can almost feel that frothiness shaping what he wrote.
Definitely colors his commentary.
Right. But even with that specific context, the core ideas he talks about, they're just timeless, really.
Okay, so let's unpack those core ideas. You mentioned rationality, decision-making. What really jumps out at you from this letter about Munger's take on being rational?
Well, it's his relentless focus on rational investing. But it wasn't just about being smart. For him, it was maybe even more about understanding and actively, deliberately avoiding the common mistakes.
The pitfalls.
Exactly. He was implicitly using mental models, like inversion thinking backward.
Yeah.
Instead of, how do I win? Asking, okay, what are all the ways I could screw this up?
Which leads right into his famous idea of avoiding standard stupidities. Sounds so simple, right? Avoid being stupid.
Huh, yeah, sounds obvious.
But why is that actually so hard for people, especially when, markets are going wild like they were in 98?
That's the beautiful thing. It's not about having some super high IQ. It's about sidestepping the predictable ways we shoot ourselves in the foot.
Like chasing hot stocks just because they're hot.
Precisely. Or letting fear or greed drive your buy-sell decisions. Classic stupidities. Munger would say, look, if you just cut out the obvious dumb moves like getting envious of your neighbor's stock picks or buying stuff you don't understand or acting out of resentment, you're already halfway there.
So it's like negative wisdom,
Yeah.
success by not doing dumb things.
Exactly. And he tied moral responsibility into that, too. It wasn't some separate, fluffy thing. It was part of rational, long-term thinking.
And that connects to deferred gratification, right? And taking the long view. That's bigger than just stocks and bonds.
Oh, absolutely. It's fundamental. Understanding that, the best outcomes often require patience. You give up the quick win for the much bigger, more sustainable gain later. That idea runs through everything he did.
Waiting for the fat pitch, building value slowly.
Instead of chasing fads, the core mindset.
Okay, so it sounds like Munger was really applying these deep philosophical principles directly to the business world. How did that actually translate into Wesco's results in 1998? Let's get into the financials a bit.
Sure. So, looking at the consolidated numbers first, Wesco's normal net operating income, the core earnings, was about $37.6 million in 98. That was actually down just a hair from $38.2 million in 97.
Okay. Pretty stable on the operating side then.
Yeah, but the overall net income, which includes things like gains on securities they held or sold, that dropped more significantly. It went from about $102 million in 97 down to roughly $72 million in 98.
Okay.
And Munger was always really careful to separate that normal operating stuff from the one-off gains. Shows his focus on the real underlying business quality, not just headline numbers.
Right, peeling back the layers. So the subsidiaries, West of IP, the insurance arm, they were mainly in super catastrophe reinsurance. Can you break that down? What is that, and why is it such a big deal?
Okay, think of it like this. It's insured for insurance companies, but only for the absolute biggest, rarest disasters. A once-in-a-century hurricane, a massive earthquake, that kind of thing. And retrocession just means Westfac was taking a small slice of that risk from another insurer, which was usually Berkshire Hathaway itself.
So really high stakes.
Extremely high stakes. Munger said a supercat insurer needs a Fort Knox balance sheet because, in one bad year, they might have to pay out way more in claims than they took in as premiums.
He called it not for the faint of heart,
Yeah.
right? And mentioned huge swings, including very unpleasant future years.
Exactly. And you see that volatility. Their underwriting profit from SuperCat was only $1.4 million in '98, down from $2.3 million the year before.
Okay. And the deal with Berkshire.
It was pretty specific. Westvac usually took 20% or less of the risk. Berkshire kept 80% or more. And Wesco paid Berkshire a 3% seeding commission, basically a fee for getting that business.
Right.
Munger had that great line about Berkshire operating with the punctilio of an honor.
The most sensitive. Yeah, I remember that line.
Right. But then he immediately clarified there were no plain giveaways. It shows that ethical side, but also, it's business. Wesco had to earn its keep, even with the Berkshire connection.
Okay, next up. Kansas Bankers Surety, KBS. WesFIC bought them in '96, right? For about $80 million cash. They did insurance for smaller banks, mostly Midwest.
That's right. And the interesting thing for them in '98 was a big operational shift. They decided to keep more of the risk themselves.
How so?
They massively cut back on ceded premiums, meaning they reinsured less of their own business out to others. They retained about 94% of the business in '98, way up from 58% in '97.
Bold move. Did it work?
It really did. Their combined ratio was fantastic, 62.2%. Basically, for every dollar they collected in premiums, they only paid out about 62 cents in claims and costs. That's incredibly profitable for an insurer, much better than average.
Nice. Okay, and Precision Steel, the other main operating business.
Precision Steel. Their contribution to that normal operating income was $3.1 million in '98, down a bit from $3.6 million in '97.
Any particular reason for the dip?
Yeah, Munger pointed to spending on upgrading their computer systems. Remember Y2K?
Oh man, Y2K, right. So necessary investment, basically?
Exactly. Just the practical cost of keeping a business running and ready for the future.
Okay, so beyond the operating businesses, Wesco had this huge position in Freddie Mac stock. This is where the numbers get kind of wild, right?
Yeah, absolutely wild. This holding, which they'd bought for only $72 million.
$72 million.
Yeah. By the end of 1998, it was worth $1.9 billion, held inside Wesco.
Wow. That's some serious compounding. A classic Munger long-term hold.
Textbook. And largely because of that massive gain, Wesco's overall net worth jumped significantly. Went from $1.76 billion, or about $248 a share in '97, up to $2.22 billion, $312 a share by the end of '98.
So how did Munger factor that huge unrealized gain into his famous intrinsic value calculation? He had that unique way of looking at the deferred taxes, right? The interest-free loan.
This is classic Munger thinking. He looked at that massive Freddie Mac gain and the huge tax bill they'd eventually have to pay if they sold it. He called that deferred tax liability an interest-free loan from the government.
Because they hadn't paid the tax yet.
Exactly. But he was super pragmatic about it. He didn't just add the full amount of the deferred tax, which is about $127 per Wesco share, to the value. He knew the tax would get paid someday, so he discounted it heavily, saying it was worth maybe $30 per share today.
Okay, so valuing the benefit of holding off on paying the tax.
Right. So he took the liquidation value, which was around $312 per share, added his discounted value for the tax loan, say $30.
Gets you to $342 per share.
Roughly, yeah. That was his estimate of Wesco's intrinsic value at the end of '98. Then he compared that to the actual stock price, which was trading around $355.
So slightly above his estimate, about 4% over.
Exactly. It's a very grounded, conservative way to think about what a business is truly worth beyond just the accounting numbers.
That's fascinating. Such a practical approach. And speaking of value and honesty, Munger made a really specific point about Wesco compared to Berkshire Hathaway. He basically said, hey, Wesco isn't just a mini Berkshire. What was the message there?
Yeah, that was crucial. And classic Munger bluntness. Berkshire owned about 80% of Wesco,
Yeah.
but he flat out said that the quality disparity has, in recent years, been widening in favor of Berkshire Hathaway.
Didn't pull any punches.
Not at all. He knew Berkshire just had better growth opportunities,
Mhm.
more places to put capital to work because of its scale and diversity. He wanted Wesco shareholders to understand that reality, that Wesco was good, but different, and maybe more limited compared to the parent company. No sugarcoating.
Which, again, speaks volumes about his approach. And that leads us nicely into his broader worldview, the lessons beyond just the numbers that he always seemed to weave into these letters. What philosophical threads stand out here?
Well, stepping back from the Wesco specifics for a second, you really see his belief that real wealth is more than just money. He was huge on lifelong learning, obsessive reading, really.
The foundation for wisdom, he thought.
Absolutely. Which then leads to better decisions everywhere, not just in your portfolio. He had that line, something like, if you're not feeling often, you're not trying hard enough, but if you're failing stupidly, you're not thinking hard enough.
Huh. Connects right back to avoiding standard stupidities. Learn from mistakes, don't repeat the obvious ones.
Exactly. It's about intellectual honesty.
And his specific market comments from 98, they feel incredibly relevant now, don't they? Talking about frothy markets, super ebullient markets, warning signs about investor behavior, irrational exuberance. It's uncanny.
It really is. His observations about speculation back then, especially in tech stocks, you could almost copy and paste them into commentary about certain periods today.
He wasn't predicting a crash necessarily.
No, not explicitly forecasting, but he was definitely pointing out the dangers when speculation gets detached from, actual business value. His core principles, prudence, avoiding the herd mentality that's exactly when you need them most, when everyone else is caught up in the excitement.
So the big question then, what can someone listening today, whether they're investing, running a startup, or just trying to be smarter, really take away from this letter from, what, over 25 years ago? Is it still useful?
Oh, absolutely, yes, unequivocally. His focus on really understanding the business you own, maintaining financial strength, not overpaying, having the patience to wait, that's timeless advice.
Or founders, too?
Definitely. The ethical stuff, thinking long-term, recognizing those dangerous emotions like envy or resentment, that's gold for building a lasting company and avoiding common startup traps. And for, regular investors, it's about thinking for yourself, not just following the crowd.
Master the basics, avoid the dumb mistakes.
That's the core of it, whatever the year.
Digging into this one specific older shareholder letter really does show the lasting power of Munger's thinking, how you can pull real wisdom out of what looks like just a dry financial report.
Yeah, the main takeaway for me is just how much Munger demonstrated that a deep grasp of business, combined with psychology, plus that disciplined rationality, it's just far more valuable than chasing whatever's hot this week.
It's a framework for thinking, really, for markets, for life.
Exactly.
All right, so here's something for you, the listener, to chew on until our next deep dive. Given everything going on in the markets today, if Munger were writing a 2025 version of this Wesco letter, what parts of his core wisdom do you think would be exactly the same? And maybe more interestingly, what new specific warnings or insights might he offer for right now?